All right, welcome back, guys. We have just seen a record-breaking 3-day market correction. Correction is the cuter term Wall Street likes to use for losing obscene amounts of money. Now, overnight, S&P 500 futures were down as much as 22% from the top, and that really puts us in the range of flirting with bear market territory. Now, we've been talking about this being an inflection point. Are we going to see that quicker V-shaped recovery like we did in August of last year? Or is this going to be a longer, drawn-out bear market like we had to endure in 2022? I think we're one step closer to getting that clarity, and while things may feel bearish, not all hope is lost for the bulls. Join me on this wild Monday market overview as we discuss this historic drop and how to position for what lies ahead. This one is not to be missed. This isn't financial advice. Past results are not indicative of future performance. Do your own research. Welcome back to The Trading Apologist. My name is Tom, and thank you so much for joining me today. I hope you guys are all doing okay after these unprecedented few days in markets. I know it's rough out there, but if a rough spell like this can serve any good, it's to be a reminder of what fear and greed look like. And if you're going counter to trend, now would actually be the time to start getting a little bit greedy, to start building positions. Whereas December and January, where we had peak euphoria, that would be a time to start trimming some off the top. I did a little bit of that. I wish I would have done more. Hindsight is always 20/20. But our aim as traders and investors is to learn and grow. And that's the best we can do day to day. Learn from our mistakes and try to increase our batting average. Now, we're not going to really talk much about the macro today because we did so much of that in the videos last week. However, if you are interested in any of that, you can go back to the videos. Fridays in particular, from about the 2-minute 30 mark to the 7-minute mark, we talked about tariffs in detail. So if you want to catch up on that, that's a great one to check out. Before we dive into the charts, though, I think particularly at uncertain times like this in the market, it's important to spend just a moment to talk about mindset and strategy for these uncertain times. First, you always need to know your stance as an investor. The only way to succeed in markets is through consistency. And you can't be consistent if you don't even know what position you're taking. So there are 5 primary positions you can take. And this could change daily, weekly, monthly, depending on the kind of trading you're doing and where you're at in the markets. The first action or position stance you could take is to sit on the sidelines, not do anything. And no action is in itself an action. So if you're day trading and you don't have time today to look at the charts, you're busy, okay, I'm going to sit this one out. If you're swing trading and a season is just too choppy for you or there's uncertainty, I want to sit on cash, you're making that decision. But if you're active in the markets, you can either be an aggressive bull, a cautious bear, or an aggressive bear. For me, that means letting the trends lead the way, and I shift my stance as these longer-term trends change. Now, since the beginning of 2023, I've had an aggressive bullish stance in the markets, and I've just changed that recently to being more of a cautious bull. As we've discussed in past videos, my strategy has changed from more of an investment thesis to trading the swings, shorter term investments as we're getting into more market volatility. That means I'm layering in more at conservative levels. I'm looking for entries with clear invalidation points and stop losses. And I'm also monitoring my position size to keep cash and margin on the sideline for future opportunities. If we break down those 3 steps by the charts, I'll just show you a couple examples on certain stocks. So looking at Tesla here for the first one for layering in at more conservative levels. If I was still an aggressive bull on Tesla, I would have deployed more around the mid $300 range at this key support level, and then again at $315. But I saw this downtrend and what was happening in markets and the negative sentiment, so I told myself just to wait. And I drew out these key consolidation zones here. And I just took a very small nibble once we came to this blue line here, which was at the 300 level. Then I took another little nibble at that 270 range. Then again at 240. And then I really got in heavy at that 220 mark. But I still didn't deploy all of my position because I've been monitoring this trend line down here. And we've had so many headwinds, negative sentiment, and now everything that's happening with tariffs. And even though that's not affecting Tesla, it can get swept up in the negative sentiment. So normally by here, I would have deployed 100% of my position size, but I've only deployed 60% of what I want to deploy, and I've saved 40% of that dry powder for the eventuality that we might come back down to this diagonal uptrending support line. If Tesla rallies from here, that's the price I pay for certainty that we're going back up, and I'll just have to buy in at higher prices, or I can roll that cash into another position. Talking about entering positions with clear invalidations, I'll go back to the MU chart, which we've looked at the last couple of weeks, and we were in this clear consolidation range, and I was trading it from support to resistance on multiple swings. And I exited my last position here. You can't see it on the daily chart, but overnight it hit 108. Exited there, and then I entered again a little bit here at this key volume level, and then again here at support, and I had my stop loss just below. And when we broke down last week, I got stopped out of that position with a minimal loss, but I'm picking positions that have very clear invalidation levels, so I'm minimizing my risk. We'll talk more about a new potential entry on MU as we get into the charts in just a moment. For the last one about monitoring position size and keeping cash and margin on the sidelines for future opportunities, Hood would be a great example for that. So I got into my position right here on this support line, and I wrote it up into earnings, and since then we've had the broader market breakdown. In normal times, with all the tailwinds and not being affected by tariffs, I think Hood could potentially go higher. But I didn't deploy the full position size I wanted to. I just deployed 30% of what I want to enter into Hood. And now new opportunities are presenting themselves. We had a great bounce today, but because I'm more of a cautious bull at this stage in the market, I'm waiting for key levels. So for me, that means I would enter another 20% of my position right around here, just below where we are at 28, and I have that limit order placed. And then the rest of my position, I would deploy at this very strong support at $24.50, call it $25. I think I have my limit order set just above $25 because you want to be ahead of line. If everybody has their orders placed there, it might never get down to your level. And you can just see going all the way back to June of 24, all those times we bumped up against that level. If we turn on the VRPV, you'll see we come into really big volume clusters there. So that's how I'm thinking about it, being a bit more conservative at this phase of the market. So I hope that helps sharpen up the idea of how that change in stance impacts your investing decisions. If I were to switch to being more of a cautious bear or an aggressive bear, then obviously that would change the positions I'm taking and how I'm layering into potentially shorts or defensive sectors. Anyway, I think it's just important to have a thesis, to know why you're making your investment decisions, and to have convictions in your trades. If you don't have convictions in your trades, you can't hold through those bumps and undulations in the market. And you also don't want to be just blindly buying into positions because some influencer said to do it or because you happen to like the company. You need to have a thesis that's backed by fundamentals and how you see the macro. And you also need to be flexible to adapt that as the world changes, and know that you could be wrong, or your thesis might be right for a time and then is going to shift, and you need to be ready to be flexible and move your investment decisions along with that changing landscape. So for me, my thesis has been that we are going to see a bigger correction, but I didn't think it would happen for another 12, 18, maybe 24 months. And that's based on the 18.6-year real estate cycle. The U.S. is mounting debt problems and things of that nature. And I'm still leaning towards that thesis being correct. But given this tariff concern, I'm also starting to give in the back of my mind a 10 to 15% weighting to the idea that maybe the bull market is over. That's not my base case. However, I want to be flexible and adaptable, and I'm training myself to entertain these ideas that go counter to what my thinking has been that has made me successful over the last couple of years. Now, I still give more weight to my primary thesis, since deals could be struck to make this tariff thing go away. Monetary policy is easing. We're seeing that money printing is going to start in China, and we've had loads of liquidity floating into the system globally. So I still give my base case a greater weighting. However, as things shift and evolve, I want to be ready to adapt. Now, the last thing I'll say is that we are experiencing unusual market conditions. What we have seen the last 3 days is not normal for markets, and they are not reacting to fundamentals. They're reacting to news. And at times like that, where an announcement from the White House can throw the market into wild swings, you need to step back from the short-term charts and the normal technical analysis that you would do. The only thing I'm relying on right now as far as charting goes is the longer term charts. So at the very shortest, the daily, but really I'm looking at the weekly for key levels of support at times like this. We will get back to normal market conditions, but know the kind of market you're in and know that the things you normally rely on might not hold up at times like this. Okay, I'm just going to get into Forex Factory really quickly. The main things this week: on Wednesday, we have the FOMC meeting minutes from last month, which might move the markets a little bit if there's more of a dovish tone to those. But the key things are really Thursday and Friday. Thursday, we have core CPI coming out, and then Friday, we have PMI. There will be more of a weighting to the CPI than the PMI, but still, those are bigger events that could move markets. The main thing to look out for that could move markets are announcements from the White House regarding tariffs. What deals are being struck with other nations? Are things potentially going to be delayed? That's what's really going to move things this week. Okay, so looking at the charts, I turned off all the indicators so we can just see the candles here. And we have that historic 3 candles down with now a bounce today off key support. Actually, if you pull up the SPY chart instead of the SPX to see the overnight trading, you'll see that we had a little double bottom bounce. So we'll see if that can hold. But what I really want to do is zoom out to the weekly and just compare this to past drops. We have the COVID drop here. We have the 2022 bear market right here. And we have our current drop. And in terms of points, these are now all just about equal. This one has been a little bigger, but they're all around 1,300 points. Percentage-wise, this hasn't been as great as these because we're at higher levels, but we've dropped 1,300 points on each of them. We have some uptrending support coming potentially here, but the main thing I want to look at from the lows of 2022 right here to the highs of January right there, we are exactly on the 50% level, and we are also on that previous peak right before the 2022 bear market. So if support is going to come in at any point, this is really where it has to happen for us on the S&P. We've already had a lot of damage done by this drop, but if we can see a solid recovery and if we can get above these past highs right here that we rejected from, and ideally above the 200 MA, that would really help put us in a stronger position. If, on the other hand, we have a weak bounce, set another lower high, drop below the 50%, and test that from the underside and reject, that would really take us into a bigger correction. And I hate to even say this, but that could be a couple years of downward or sideways action till we see all-time highs again. And we just need to be careful and know that even if we bounce into new all-time highs, that eventually a bigger correction is coming to reset the market. Okay, one last thing I'm going to do is I'm going to pull up an overlay of MMTH. And what this is, a percentage of stocks above the 200-day average. And what you can see here when we compare this, right now, not many stocks are above their 200-day average. But you can see that these extreme spikes generally coincide with lows in the market. So that's the COVID low. Here we have the bottom of the 22 bear market. Here we have the October low of 23. And then we have where we are currently. And you can see that comparatively, this is right in line with where we start finding bottoms. So this is one sign of hope on the S&P 500. And last thing I'll say on the S&P, just getting in a little closer on the daily here. So we did have a big spike up today. This came off of news that were afterwards said to be false from the White House, that there was going to be a 90-day delay on tariffs. So you can see how eager the market is for that sign of positive news. But then when the White House said that that was false, then we dropped right back down, but we did find support and we closed the day fairly strong. I would love to, in the short term, have us get above 5,100, which is the bottom of that August low from last year. And then we've got our next key levels at 5,400 to tackle before we can really close this meaningful gap at 55.7 to 5,600. But to get into all-time highs, we have this swing top here. This right here will be our line in the sand at 5,800. If we can get above that, then I would say we're going back to all-time highs. But all these levels are ones to watch along the way for resistance. Now, you might have an individual stock you're trading that's bucking the trend, that's doing better, but it's important to keep your eye on this as the key indice and the leader of the market to see where those broader trends are heading. If we take a quick look at the NASDQ, you'll see a very similar chart. We had a slightly stronger close by a few points, and we are right at the bottom of that August low. Again, this is moving a bit in tandem with the SPX, but tech is outperforming slightly. And if you look at the Amazon chart the last couple of trading days, it's actually been stronger than the rest of tech. So right now is a time to look for outliers, and those outliers, once market sentiment does reset and we bounce, because no downtrend is going to last forever, and sometimes these bounces in extreme conditions can be some of the fastest and quickest percentage gain. Looking for those outliers that have strength and noting them in your trading journal now is going to let you get in the right positions to maximize on those trends. Now, one last one I'm going to pull up is the HSI, the Hang Seng. And I've been playing in this market since the fall of last year, as we saw that first stimulus come into China and then a bit of a cool off, second round of stimulus. They got hit really hard. They were down more than anyone at 14% on the day. And they are at, 22% top to bottom? What was it? Might even be a little bit more. Top to bottom, 22.3%. So this market got really beat up. There are lots of tensions between China and the US. Obviously, right now, their economy is shifting. They have a birth rate problem, but they are injecting lots of liquidity, and I think we are going to see that continue. There are talks that anywhere from 500 billion to $1 trillion could be printed by the government in the near term to help stimulate. So keep your eyes on this one. There could be some great recoveries in the leading names in the HSI. And on the DXY, we came up a little bit higher today, but we're still in this previous support/resistance zone. So this is really one to watch to see if we're going to break through this zone and go up, or if we're going to reject from here and continue our trajectory downward. I think long-term, the trajectory of the DXY is still to the downside, but while there's this weakness in markets and uncertainty, the dollar might find a little bit of strength. Okay, moving on to SMH, the semiconductor ETF. You can see, like the broader market, we had a strong bounce today. I actually had this alert set at 195 that didn't quite get hit. We're still away from that underside support from that almost year-long trading range. Decent bounce, almost a 50% pullback. I'm still weary on this sector with all the weakness it's shown, but let's keep our eyes on it and keep our eyes on NVDA. NVDA is looking a little bit stronger, trading back into that zone. We did break below our key support, but just wicked below and then got back above this big volume range. So this is looking slightly stronger. I know a friend who bought really hard at 88 today. He almost nailed the bottom. So he has a lot of conviction in it. But right now we're still just setting lower highs and lower lows. So until that trend breaks, and with the weakness that's been in the sector, even though I believe in it long term, I am more in the camp of, well, let's wait for confirmation. Like, you could buy this, and even if it bounces and rejects and goes a little bit lower and then recovers, you wouldn't be doing too badly. But generally, you're always better off buying on confirmation. If you can get a bounce that goes above that last low and then sets a higher low, and you can get an entry in this range right here before it goes on that next move, that's a much safer entry and has a higher probability, especially if you're sitting above these support ranges. So that's just the importance of watching charts, and particularly in the market like this where things have broken down, there is uncertainty. I think it's smarter to wait for confirmations. I'm going to blast through these ones really quickly. Gold did break down with the rest of the market the last few days, even though it is seen as a hedge. It did go below this $3,000 support area, which I would have loved to see it hold. So there's a little bit of weakness in gold right now. If we get a bounce from here, we need to really watch this to see if we set a lower high, or if maybe this goes into a bit of consolidation and distribution, just like we had right here. So maybe it goes into, just a little bit of a holding pattern of indecision before it figures out what its next move is going to be. But I'm not doing anything on gold right now. Like I said, I think 2/3 of the move are done because retail's in it now, and the time to get in was really a year and a half or so ago. Silver had that really strong rejection last week, got hammered down almost 14%. It's finding support in this box that we outlined last week. But again, with gold consolidating, with all the weakness, I don't know how quickly silver is going to move. I'm going to keep my eyes on it, but I'm not doing anything with silver right now. Oil broke down from that support. We have other levels that we can be looking at, like maybe right down here at the bottom of this range. This is on the weekly, by the way, so we are going way back in time. Let's see how that... So that lines up kind of with that volume range, that $57. I would say that 57, let's say, to $60 range. So I would just say watch that underside support from oil. Again, as we discussed, at a certain point down in this range, it doesn't become profitable to drill anymore. I would watch these next support levels, and I would anticipate a bounce sooner than later, but it is good for inflation if oil prices keep dropping to the south side. All right, so I'm just going to pull up a new one real quick. I don't even have the chart here, but I got a limit order fill on this one, and I'm not talking about everything I'm doing because I'm watching a lot of things, but this is Novo Nordisk. They're the makers of Ozempic, and I can't think of the name of the other drug they make, but they got beat up by competitors coming into the market. They had a new drug that only performed at 22% fat loss instead of their target of 25%. So their stock has been dropping after this big rally. Normally, I don't like to play biotech or pharma. Some of those are personal reasons, but biotech can also be led on a hype cycle of drugs working or not working, as we obviously saw by this sell-off. But what I was talking about earlier with playing key long-term levels, right here at $58, on November of 21, we came up and we tested this from the underside for so long, and then we had an impulsive breakout. So this $58 level is providing strong support, and actually I had a limit order right here because, again, like I said, you want to get in front of the line. So I had my limit order at $61.50 that got filled for just a very small position, and if it comes down here to that $59 mark, I would probably add to this and expect some bounce up to maybe about the $85 range, maybe conservatively start trimming around like $78 into that. But with how beat up this has been, it should see a bounce. And I think the important thing to train yourself on is when you see a drop like this isn't normal. So expect a bounce, but don't expect that bounce to go to all-time highs. The most likely outcome is a weekly or a monthly lower high, and then going into some form of consolidation range until the stock decides which way it wants to break. And so this is most likely going to enter a period of this kind of chop while the market figures out what it wants to do, and maybe they'll have an announcement of a great new wonder drug down the line and it'll shoot back up to new all-time highs. But just expect this kind of consolidation after big explosive moves like this and big retracements. Okay, moving on to Tesla. We already covered this a lot in the intro where I was talking about position sizing. And as we hit the lows overnight, I think we got to 211 or something. I didn't quite nail that. I think I got in at 215. I didn't do a straight equity buy. I actually did a swap. I swapped some of my MicroStrategy for Tesla because MicroStrategy was at 260. I have a lot of it from the bottom of the bear, and I think Tesla will recover more rapidly from here. Again, because there's still a chance, the cash I'm sitting on that I have allocated to Tesla position, I'm waiting to deploy that until we hit down here around that 180 range, maybe 170 if we intersect that line a little bit sooner. And if it doesn't happen, I'm happy at buying at higher prices if we break this top at 190. My trigger for getting back in with my cash position instead of buying down here is if we break that 300 to 315 mark, then I would say we're off to the races to test higher highs. All right, switching back to the webcam here, it's getting a little bit dark. I think one important thing to talk about, what I mentioned with swapping MicroStrategy for Tesla, is that you don't always have to go into cash. Think of everything as a pair. If you have one asset that has run a lot and there's another asset that hasn't run, you can switch that for a lot more shares of the asset that hasn't run yet. And if there are pairs that are a bit inverse in different sectors, granted right now the market is kind of all going down together, but in normal times, if one thing has run, another hasn't, and it's time for that other thing to run, it can be quite lucrative to just try to swap from one asset to another and increase your share count of each of those assets. And you can go back and forth if they're assets that are inversely correlated. So going on to Bitcoin now. As we said last week, Bitcoin was holding up quite strong, and it was holding this support at the low $80,000 range. When the rest of the market had already dumped, Bitcoin was holding this. And now Sunday night, as global markets started to open and things were dumping all over the place, but people couldn't trade yet, the only thing they had was Bitcoin. So this was kind of a laggard bear on this move, but I don't think it was bearish because the sentiment on Bitcoin is bearish. I think there's actually still a lot of strong momentum behind Bitcoin. I think it was just a factor of people seeing global equities dumping. They have nothing to sell on a Sunday night except their crypto. So Bitcoin and crypto unfortunately got sucked up in that. But we had a very strong bounce from close to what I would say is the last line in the sand here at that 73.6 level, which is this last swing top and lines up with this high in March of 2024. So we bounced away from that. I would really like to see that hold. But now you can see we had this support here, and let me zoom in a little bit more, or let's go to the 4 hour. Why not? We're really going to get in there. So you can see we had this holding at support 1, 2, 3, and then the fourth time we broke down. And then as we got that news of tariffs potentially being delayed, bulls rallied right up into that, but the bears were ready to sell at that level. So that 81,000 and change, that's really the line in the sand in the short term that we need to get above. I'm watching that closely for Bitcoin to continue to be an asset that's faring a little bit stronger in these uncertain times, is something that's not impacted by tariffs. Another thing to mention, just as a quick TA tip, often we'll see breakdowns on a fourth time retest, and this is just on the 4 hour, but you can see we had 1, 2, 3, and then a fourth time test of that line, and on the fourth time we finally broke down from that swing. More often than not, if you go back in history and look at the charts, if there is a key level of support or resistance and it keeps being tested, on that fourth time, it will generally break through. Now, on the bear side, on the RSI on the daily, we did have this underside support that broke down, and we broke back below this downtrend from the top side. Granted, we don't have too much to retrace on the daily on the RSI, so maybe this isn't going to be a long downturn, but we did lose that. The other thing we're flirting with is this key level of support I mentioned on the weekly RSI at 44.2. You can see this has played as support for the entire bull market. Let me just bring that down a little bit. And you can see even back here, going back to the previous bull market, we dipped below a little bit right there. You can see it was generally support for those two peaks in the bull market. And then as we got in the bear, we got below that 44 and change on the weekly RSI. Now we bounced away from it 2 weeks ago, and now we're just flirting with it again right now. So we need to see a positive reaction on the weekly RSI this week. And Bitcoin is really at a decision point. Can we bounce away from that, this downtrending resistance that we've had on the chart? Can we get above that? And then beyond that, we really need to break that 88,500 of that previous swing top. And then this is my line in the sand, that 91.5. If we can get back within this previous consolidation range on Bitcoin, that would make me a happy camper. But one step at a time. Can we break this downtrending resistance right here? Can this key support on the underside hold? Those are the two lines in the sand that we are watching over the next couple weeks. If this breaks and holds and we get up to these higher levels, just be looking to Bitcoin for relative strength compared to the rest of the market in this tumultuous time. Okay, one very last thing I wanted to pull up on Bitcoin is that global liquidity chart that we pulled up a couple weeks ago. And we have this 108-day offset with the chart. So this is the current stance of global liquidity. But if you take this back 108 days, that puts us on January 20th, on Inauguration Day, 4.6 trillion started coming into the market. And we have been following this global liquidity chart quite closely. When we looked at it last week, we were up here in this range, and I was thinking, oh man, do we have to take this dip? But lo and behold, we're following pretty closely. So this is another one to keep your eye on. Could we keep tracking this and consolidating? I don't know. I mean, all the way to this inflection point on the 12th of May, and then do we start going up from there? That's certainly a possibility. The impatient bull in me would love to see a reaction sooner, but we've been tracking this quite closely. So tracking global liquidity compared to Bitcoin, I think, is one that's very important to keep tabs on. Okay, guys, Solana, I'm going to be a bit of a Debbie Downer on this one. I apologize in advance. I am a huge Sol bull. I believe in the technology. It's faster, better, cheaper than other chains. It has the highest monthly revenue for, 4 months on record now. It's taking market share away from Ethereum, all those good things. But if we're just looking at the charts, and again, we're looking at the daily RSI, we broke down from that. We are making a lower low here on the charts. We still have this resistance line, and we broke that key psychological 100 support today. We also broke this key $112 range that had been support time and time again. So yesterday we really broke down from a key level on the daily, and we rejected from it today. And I think we just need to be realistic that there could be more pain in store for Solana. I'm still believing it long term, but there is a good chance we could get to that $77 level, which would be that next major underside support. And it used to be resistance here and then provided support way back in January of 24. Going back to January of 2024, we had this underside support that we really started breaking right before Trump announced the strategic crypto reserve. And then we rejected from that exact line on the 25th of March. And it's been down since there. So while we broke above this downtrending resistance, we still have this line. And now we have this as a hurdle to get on top of, which right now at this point is intersecting with $150. I would say this diagonal line and the $150 level are really our lines in the sand on the upside that we need to get above. But given the trend things are in and that crypto is breaking down against Bitcoin, I wouldn't be surprised to see this $77 level. Okay, coming back to MicroStrategy, with the rest of the market, we did have a bit of a breakdown, but we bounced perfectly off the 200 MA at about 250. We came all the way back up today to almost 300. And like I mentioned, I made that swap into Tesla when we were around that 260, 270 range right here at this blue line. I would say this one, it's just a little bit of a wait and see. We have this downtrending resistance. We have the 200 MA. If Bitcoin continues to go up, I think this will break positively. If Bitcoin goes down, I think we're going to lose that 200 MA support. Just keep your eyes on this as a proxy. Bitcoin is the leader, and this is going to follow. Moving on to Hood, we already talked about this. It broke below the 200 MA, closed back above. We had a solid bounce. I still have these two limit orders in at $28 and at $24. If we break away from here and those don't hit, I'm not upset about it. But right now we are at these previous swing bottoms and a bit of resistance at 35 and change. So let's watch Hood and see if this support holds or if we test some lower levels before eventually going back up. But again, because of all the fundamentals, because of the adoption, the revenues, the trading pairs, now the sports betting too, which I'm getting advertising for that I hate, I'm continuing to keep my eye on this one, and I'm positive on it for the long term. And, I would love some entries down here to get my cost basis down. So we'll see. MU, we discussed briefly in the intro, just looking at this volume support here and these past support levels that we bounced off perfectly at $60. I would say this is looking promising because this $60 has really provided a lot of bounce support, and we're in the middle of this volume cluster. We had a strong bounce today. We closed a little lower than I would have liked. I would have liked us to close above that $70 mark, but keep your eye on MU to see if we can bounce away from here. If it does have upside in it, this could be a quick one where you make a nice percentage gain. Again, these swings, I was playing these for just like a week or so at a time, or a week or two if we were in consolidation, and was able to make a lot of money on that. Moving on to Celsius. This one is looking really strong. We're trending slowly upward. We have underside support. So this to me is forming a bit of a bull flag, even if we go into a bit of consolidation. And again, just watching that $38 level for a break. If we can get above that $38 to $42.50 range, I think we've got a long way to run on this one, and it's continued to prove its strength. Deckers continues its bounce away on the positive Vietnam news. It really got beat up, and this $95 level Again, as we're talking about looking at the long-term charts, if we go back on the weekly on Deckers, where do you see stronger support? Well, I mean, I guess down here. But unless you're going way back down here to $75, you don't see any stronger support than that $94, $95 level that used to be resistance. And then we had that impulsive breakout and went on this huge multi-year rally. So again, I would compare this to similar to Novo Nordisk. Like, we're probably not going to make new all-time highs. There's a good chance we're going to bounce, form a lower high, and then go into some kind of consolidation range while this figures things out. Sure, in the long term, it might go up, but I wouldn't expect this to go to all-time highs tomorrow. I would expect to just play this swing, then know that hopefully a higher low is the next step in consolidation. If a lower low comes, then that's your signal that maybe you should get out of this one and it's in for more trouble. Moving over to Palantir, we did break this support range, but we did bounce right back into it, had a strong bounce today. I'm personally not playing it, but again, watch this one. Like the other charts, we need to break above that 50% and we need to set a higher high on a recovery if we're going to continue to all-time highs. If we don't do that and we just bounce away and say maybe reject at this key level here at 83 and change and then continue lower, that's your sign that's going to continue to break down. But again, like these others we've been discussing, there's a chance after this blow off top that the most probable thing is maybe some kind of consolidation range. Just get ready for that could happen on a lot of these names. SMCI, we tracked this one on the breakdown. I said I wasn't too confident on it, but luckily we held those last lows. We came back up. This underside support proved to be a bit of resistance today. This one has a bit of work to do in my book, but if we can get above this and test it for support and break away and get above this previous range here, then this one could potentially run again. If you look at this one historically, we are still way, way, way off all-time highs. And this downtrending resistance is the key thing to watch. If we can break above that, then this potentially has a ways to run, and you've just got a level around $66 to watch here. Okay, SMLR Scientific, same thing here. We flipped this downtrending resistance to support. We dipped below it the last couple of days with all the volatility, but we bounced away strongly and then took away some of that move today. I'm still watching this one, and it's looking like it's holding to me for now. I'm slowly adding to this position and I'm hoping for a bounce away, but we did break to slightly lower lows here than we had over here. So treading cautiously with this one, but again, support is sometimes more of a range than it is an exact price level. So you can see we had a cluster of consolidation back here that lines up with this whole zone. So that was from October of 24. And we're back into that. It provided support right at the top. Now we broke into the middle of it. If we break down below this and don't hold this trend line over the next couple of weeks, then that would be my sign to exit that position, but I'm just watching it daily now to see what it can do. Okay, so those are the main charts I'm watching right now. The indices, and particularly the S&P 500, are the leading items to watch. That 50% level is all important to give us a lead on which way the market is heading. Beyond that, I'm watching Bitcoin and crypto since they showed relative strength last week. If tariff tensions ease, we know liquidity is coming into the system, monetary policy is easing, and those could lead the market in the next leg of the bull market and could really be a higher beta play. But again, so much is dependent on the news right now, and we need to see which way things are going to break. Just remember that there's always another opportunity out there. No matter what kind of market we're in, you just need to know and adapt your trading plan and strategy to fit those market conditions. So I'll check in with you guys on Friday for the market wrap up, where I'm sure things will look far different than now and we'll have a lot more to talk about. I'll see you then. Bye.